Hello class, wanted to talk to you about another definition, particularly revenue, that sometimes gives us a little trouble and is going to be used throughout this semester, Accounting 101. So we need to know revenue well. So to talk about revenue, we're going to ask the question, what is a revenue? Under current accounting rules, revenue requires four things. First of all, it requires an agreement between a company and a customer. So there must be an agreement. It doesn't have to be in writing, but it needs to be an agreement between the customer and the company. That agreement must have an element where you provide goods or services according to that agreement. So the company provides goods or services. In essence, it earns the revenue. It has to do something for there to be revenue. That then results in a transfer of ownership or control. So for instance, if you go to Walmart and purchase something, you get to leave with that item. They have transferred ownership or control to you. And then there needs to be a reasonable expectation that payment will be made. So the agreement should indicate how that payment will be made. It may be made now or it may be made later, but you, the company, must have an expectation to receive that from the customer. So the customer can't be broke. And then the amount of revenue is the amount that's most likely to be received according to the agreement. So that's how much it is. So that is what a revenue is. So perhaps we'll spend some time talking about what a revenue is not, because there's some things that sometimes get confused. First of all, it is not an asset. For instance, cash is not revenue. Cash may be the form which you receive revenue, but remember, revenue is the amount we earned. Cash may be the form in which it is paid to us. Or it could be that they're going to pay us later. The customer is going to pay us later. Then it would be accounts receivable. Neither one of these, both of these are assets. Neither of them are revenues themselves. It is not a liability. That kind of seems obvious at first, but there are a couple times when those get very closely related. For instance, the concept of unearned revenue. This is when someone has given us money to provide, according to agreement, to provide goods or services in the future. So far we have not provided the goods or services. We have not earned it. So it is unearned revenue, and it is considered a liability because we owe them the goods or services according to the agreement. A loan is a situation where we receive cash or other assets, but we promise to pay them back. So there is no goods or services provided. There's only an agreement that we will pay them back, usually with interest. So those are two things where we receive money or an asset, but we have not earned it yet, or we have to either provide the services in the future or pay them back for the money that we received. It is not an expense. Expenses are related to revenues in that they are costs that are incurred to earn revenue. So we earn revenue by selling things. Say Walmart, again, our example. They sell things, but they have costs. For instance, the cost of the stuff on the shelves is an expense necessary to earn the revenue, or the lights on, or the wages to the employees are needed to earn the revenue.